Market participants had little rest last week as gremlins seemed to toy with the markets following the prior week's sell-off. The major markets ended mixed, with slight gains in the Dow Jones and the S&P 500. The muted weekly gains served as an allusion to the volatility that took place each day last week. Overseas, European markets seemed to parallel the results of the domestic market as the flat weekly performance masked the tensions taking place in the headlines. British Prime Minister Theresa May faced down disgruntled Tory party members looking to hold a vote of no confidence, who told her to bring her own noose to a weekend meeting. This came as she floated the idea to extend the Brexit transition period with EU officials. Remainers, those looking to cancel the Brexit vote and remain part of the EU, pushed for a second Brexit referendum in the midst of conversations of delay regarding the Brexit conclusion set to take place on March 29, 2019. Back stateside, despite a number of positive earnings releases, financials offered up little in terms of gains for the week. Yet the more interest rate sensitive sectors of consumer staples, real estate, and utilities did manage to climb higher. The remaining segments of the S&P failed to offer up much in terms of gains, and 5 had a fair amount of losses for the 5-day session. Speaking of interest rates, the FOMC minutes were released midweek. The September report had a hawkish tone at times. A number of officials expressed inflation concerns, stating that a few participants expected that policy would need to become modestly restrictive for a time, and a number judged that it would be necessary to temporarily raise the federal funds rate above their assessment of its longer-run level in order to reduce the risk of sustained overshooting of the committee's 2% inflation objective or the risk posed by significant financial imbalances. In other words, expect higher interest rates in the future. The CME FedWatch tool now points to an 83.7% probability of another 25 basis point increase to the Fed funds rate at the final FOMC meeting for this year in December. As a result, treasuries rose higher again while bond indices fell in response. The Bloomberg Barclays U.S. Aggregate Bond Index fell yet again to sit at a loss of 2.5% year to date. Meanwhile, the highest quality U.S. corporates are now down 4.75% for the year.